When foreign investors enter Vietnam, most attention naturally goes toward business growth. Market expansion, sales, hiring, operations, and customer acquisition, compliance often becomes secondary, especially accounting and audit compliance. Many foreign-owned companies assume that as long as taxes are filed and bookkeeping appears organized, the business is operating safely. But in Vietnam, some of the most serious compliance risks remain hidden until the annual audit process begins. And by the time those risks become visible, the consequences may already be expensive. One of the most common mistakes foreign investors make in Vietnam is assuming outsourced accounting automatically means compliance is fully under control. In reality, not all accounting providers operate at the same standard. Some focus mainly on monthly tax filing obligations, others may lack experience supporting foreign invested companies. Communication may be limited, documentation management may be weak, and proactive compliance advice may not exist at all. As long as no audit occurs, these weaknesses often remain unnoticed. But during the annual audit process, problems that accumulated quietly over months or years suddenly surface all at once. One of the biggest misunderstandings among foreign-owned companies in Vietnam is believing audit risks begin during the audit itself. In reality, most audit problems are created much earlier. They begin with weak documentation practices, poor internal coordination, unclear accounting treatment, or inconsistent operational records. For example, contracts may not properly support recorded transactions. Invoices may be incomplete, bank transfers may lack sufficient explanation, payroll records may not align with labor declarations, or intercompany transactions may not be properly documented. These issues develop gradually during normal operations, but auditors eventually uncover them when reviewing the company's financial records. Many foreign investors operating in Vietnam regularly engage in transactions with overseas parent companies or affiliated entities. Management fees, service charges, loans, software licensing, operational reimbursements, or intellectual property arrangements, however, these transactions often receive higher scrutiny during audits in Vietnam. If agreements are incomplete, pricing justification is weak, or supporting documentation is insufficient, auditors may question whether the accounting treatment is appropriate. In more serious situations, these issues may later attract attention from tax authorities as well. For FDI companies, intercompany transactions are one of the most underestimated audit risks in Vietnam. Another audit risk many foreign investors ignore involves payroll and labor compliance. In many companies, payroll data is managed separately from accounting records and HR documentation. Over time, inconsistencies begin appearing between employment contracts, payroll reports, social insurance declarations, and tax filings. Sometimes allowances are handled incorrectly, sometimes contractor arrangements are improperly classified. And sometimes employee benefits are recorded inconsistently across different systems. During daily operations, management may never notice these discrepancies. But during the audit process, auditors often identify these inconsistencies quickly, and once discovered, the company may face broader compliance exposure beyond the audit itself. Many startups and SME foreign investors entering Vietnam understandably want to reduce operational expenses. And accounting providers are often selected mainly based on low fees. Unfortunately, this decision frequently creates larger compliance risks later. Some low-cost accounting providers focus primarily on submitting reports rather than building strong compliance systems. Documentation standards may be weak, communication may be reactive, and management receives little strategic guidance regarding audit readiness. At first, this may appear cost-effective, but once auditors begin reviewing the records, historical weaknesses often become extremely expensive to correct. The company may then face additional accounting fees, audit delays, tax exposure, or operational disruption. Imagine a foreign-owned, consulting company operating successfully in Vietnam for several years. The business grows steadily, new employees are hired, clients increase, revenue expands. Management believes compliance is functioning properly because monthly reports are submitted consistently, but during annual audit season, auditors identify multiple concerns. Several expenses lack supporting documentation, intercompany reimbursements are poorly documented, payroll records contain inconsistencies, and some accounting classifications do not accurately reflect operational reality. Management suddenly realizes the company's compliance structure was never designed for audit defensibility. The business then spends weeks reconstructing historical records and responding to auditor concerns under significant pressure. This situation is far more common in Vietnam than foreign investors realize. For foreign-owned companies in Vietnam, audit problems rarely remain isolated accounting issues. Weak audit outcomes may affect tax inspections, profit repatriation, investor confidence, banking relationships, future fundraising, licensing procedures, and even future exit opportunities. This is why experienced FDI companies increasingly view audit readiness as part of broader operational risk management. Because in Vietnam, strong compliance credibility often becomes a competitive advantage. At LTS Law, we regularly advise foreign investors who discover hidden compliance weaknesses during audit preparation. In many cases, the root problem is not the audit itself, it is the absence of strong accounting oversight and compliance coordination throughout the year. Although LTS Law does not directly provide accounting or audit services, we help clients identify professionally assessed accounting and audit partners experienced in supporting foreign-invested companies in Vietnam. We focus on providers with stronger English communication capability, transparency, responsiveness, ethical standards, and practical FDI experience. Because sustainable compliance requires more than filing reports, it requires building systems capable of surviving professional scrutiny. Many foreign investors only realize the importance of audit readiness when auditors begin asking difficult questions. But by that stage, correcting structural weaknesses becomes far more difficult. At LTS Law, we help foreign investors understand that strong compliance in Vietnam is built proactively, not reactively. If you are operating or planning to establish a foreign-invested company in Vietnam and require guidance on accounting oversight, audit preparation, or selecting suitable accounting and audit partners, LTS Law can support you with company establishment services and connect you with trusted professional service providers for implementation and ongoing compliance. To receive tailored guidance on these matters, please book a consultation with LTS Law. Because in Vietnam, the audit risks you ignore today may become the business risks you face tomorrow.